I think that the market now understands there is a lot of short-term volatility, but there is not a lot of long-term impact coming from these tariffs. Investors have said to themselves, this is all short-term noise. Back in April, we did the whole fear thing. We had the amnesia, right? Now, you just see people investing right through it. And a big driver of that is retail saying, buy the dip. When it goes down, it's gonna go back up later, buy the dip, buy the dip, buy the dip. This is the generation that understands reflexivity better than any generation that came before it. They realize the faster it falls, the faster it comes back. So if you see it falling rapidly, buy, not sell, don't run out the door, buy, and then it comes back. Well, Bitcoin now, we grown-ups. That means we can get 10K candles in a day on the way up too.
Pompliano begins by addressing the recent shock announcement. A 100% tariff on China dropped late Friday afternoon. Coincidence? He doesn't think so. According to Pomp, Trump's timing was intentional. He waited until after 4 p.m. on a Friday, and again just an hour before futures opened on Sunday night to control the market narrative. It's a negotiation tactic, not random chaos. Trump, he argues, is using market strength as leverage. He announces big, scary numbers to dominate headlines and frame the discussion, but eventually scales back to something the market can digest.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
He waited till after 4 o'clock on Friday to announce 100% tariff on China. Is that a coincidence? I don't think so. Then he waited to about an hour and a half or so before futures opened on Sunday night. Was that a coincidence? I don't think so. So basically what he's doing is he's trying to manipulate the conversation and trying to use strength in order to negotiate. Now, it's very hard to do this without tanking the market and people basically being, this is not going to work. One of the reasons why I believe that it is working is because the taco trade. Trump always chickens out. Now, whether you think he chickens out or not, I don't know. The hostages came back. Didn't seem like he chickened out there. I think that the market now understands there is a lot of short-term volatility, but there is not a lot of long-term impact coming from these tariffs. And so you see that in the economic data. Inflation did not come surging back. The shelves were not empty. We did not get a recession or a depression. All of the people who promised that stuff, go sit in the corner. You were wrong. The second thing is that the tariffs, he comes out with a huge number and then it rolls back into something that I think is a lot more rational. People say, okay, I could live with that, 10%, etc. The thing here with China was we already went through that whole game. We went with the big number, then we brought it back down to reality, and then bam, we come back with 100%. Now, it was retaliatory. So historically in 2025, the tariffs have been offensive. We have gone and said, oh, you like that global trade thing you got going on there? We're going to throw the tariff in first. We're taking the first shot. We're the one throwing the punch. In this case, we're the counterpuncher because China came out and started to say, oh, you know what? All those exports of rare earths, we're not going to let you guys get access to those. Trump said, okay, yeah, you want to bet? Came out with this. So long story short, a lot of noise. You can take the market, you can revive the market, Monday morning open, market goes back up, abracadabra, wave the magic wand. What I think is maybe most important though, are two things. The stock market, they don't care about the tariffs anymore, long term. Like investors have said to themselves, this is all short-term noise. Back in April, we did the whole fear thing. We had the amnesia, right? Now you just see people investing right through it. And a big driver of that is retail saying, buy the dip. When it goes down, it's going to go back up later, buy the dip, buy the dip, buy the dip. This is the generation that understands reflexivity better than any generation that came before it. They realize the faster it falls, the faster it comes back. So if you see it falling rapidly, buy, not sell, don't run out the door, buy, and then it comes back. They've been right. You can argue with whether that's a good investment strategy 20, 30 years ago. Today, it's an excellent strategy so far. The second thing is, if you look at the Bitcoin and crypto industry, is we saw $19 billion of liquidations, the greatest liquidation that the market has ever seen. Bitcoin went from 121,000 down to 108,000 in a single day. Sounds bad, right? It was back to 115, 116,000 within 48 hours. So that tells me two things. One, that wiped out all the excess leverage out of the market. What does that mean? You're clearing it out. We can go higher. That's good for business. The second thing is that Bitcoin was the only market that was open. Crypto was the only market that was open. And so every single time that a geopolitical event or a macro event occurs during hours where the stock market is closed, there's a couple more people around the world who say, wait a second, why am I trading in a market where it is closed more hours a week than it is open? This market over here is open 24/7. That's interesting to me. So you're starting to see more and more people go into that world when things like tokenization, et cetera, all happen. The markets are going to be 24/7, and the events like on Friday to Sunday are a huge reason that people are becoming looking for 24/7 markets. It's because they want to trade their assets when things happen, and you can only do that right now in the crypto market. This is one of the biggest misconceptions about Bitcoin is it is a safe haven asset. People go to it, but in moments of crisis, like not, oh, we're in a 3-month crisis, right? Because that's when Bitcoin actually does pretty well. But in the reaction to news, Bitcoin is a very, very liquid market. And because Bitcoin is a very liquid market, people panic. News breaks, sell. What do you sell? What's liquid? What's open? Bitcoin's the only thing available to sell. People are like, oh, well, gold should have gone down, but gold's not open either. A lot of people's exposure to gold is actually through the ETFs. And so when you see that, that is a different thing than the Bitcoin market. And so the Bitcoin market is available, it's liquid, and you can sell off fractions. Like there's all these advantages to it. So that is why Bitcoin ultimately goes down. If you remember, go back to March of 2020, I think it was March 12th. That was the big like sell-off day. That was the liquidity crisis, right? Bitcoin went down 50% that day. Why? Because people are looking for an asset that is liquid. A big part of the sell-off was actually after hours in the stock market. The stock market had closed, Bitcoin had been falling, stocks had been falling that day, but Bitcoin kept going. There's no circuit breakers. Why do they have circuit breakers? They're manipulating the market. The circuit breaker is there in the stock market because there's too much volatility, there's too much selling, there's too much buying, right? They're trying to slow down the market. Bitcoin doesn't have that stuff. This is a big boy market. That market is manipulated by hours of operations. It's manipulated by circuit breakers. It's manipulated in terms of how much algorithmic trading is going on there. Bitcoin is starting to get a lot more algorithmic trading, but it is still very much determined by spot buyers, humans, etc. And so like it is just a different, purer market. And therefore in moments of instant fear, post goes out on social media, immediately, 100% tariff, sell. Oh, I can only sell so many things in my portfolio. Bitcoin gets sold off. So I think that's a big driver. Now, the other thing that I took away is if we can go from 121 to 108, I'm not a mathematician, $13,000, $14,000, $15,000, depending on exactly where you measure it from, right? On the downside. Mm-hmm. Well, Bitcoin now, we grown-ups. That means we can get 10K candles in a day on the way up too. And so what you're going to start to see here is the percentage moves are still going to be quite small, but you're going to start to see the aggregate dollar amount equivalent of these percentage moves is going to get bigger and bigger. There will be a day where Bitcoin moves $15,000 to $20,000 a day, both directions, but it's going to be 1% move, right? So when you think about it from that perspective, now it becomes kind of interesting. You're like, wait a second, the world has been trained from a Bitcoin US dollar price standpoint. Percentage-wise, you don't hear a lot of people talking about it. If you watch the news, if you listen to people on podcasts or see them writing on social media, they talk about it as Bitcoin went up $2,000, Bitcoin went down $2,000, Bitcoin did that, Bitcoin hit this price milestone. They don't talk about it as Bitcoin was up, 1.5% today. I don't know why that is. Like that's very different. In the stock market, people talk about percentages much more, but the vernacular, the culture, the way that people think about Bitcoin is much more in the dollar movement than it is the percentage movement. And so that is shocking when you're like, oh my God, it dropped, $15,000. It's a big move, but historically that's not that big of a move, right? And so I think people just have to get used to now the aggregate dollars of these moves are going to get bigger and bigger.
Yeah, Bitcoin's clearly a mature asset now, right?
So I actually would push back a little bit. I don't know if it's mature yet. What I would say is at first we were like a young kid. We were an infant, then we became kind of a toddler, right? Then we became kind of a preteen. I think now we're in our teenage years. So Bitcoin's not a man or a woman yet, right? but it's like an adolescent. It's getting there. It's getting closer. But I think that there is a threshold, probably $10 trillion is the number in my mind. Once you cross over 10 trillion, now you're a grown man or a grown woman in the financial market as an asset, right? Now you have real size and maturity and a very different type of thing. And where you can see this is how many people want to bet on a teenager, right? In the regular world. Some people, right? I'll give this person a job, give them an internship, maybe give them a little bit of an investment, something like that. But that number's pretty small. It's not really until they're out of college, then you're like, okay, I'm ready to make a real bet on this person. I'll give them a real job. I'll give them, a real investment. Let's go, work together, etc. Bitcoin is in that adolescent age where there's some people willing to make some bets on it, but central banks, they're not willing to bet on it yet. Most financial institutions don't hold Bitcoin on their balance sheet yet. Most public companies don't hold Bitcoin on their balance sheet yet. And so it is more mature than it was, but we're not an adult yet. We still got some ways to go.
Now, let's address the elephant in the room. The bubble narrative. Pomp pushes back hard on the claim that we're in a market bubble. His reasoning? You can't have a bubble if everyone's screaming that there's one. True bubbles happen when euphoria blinds everyone to risk, not when every pundit is warning of doom. Even legendary investors like Howard Marks and Jamie Dimon, typically conservative voices, are acknowledging that we're still in a bull market with strong fundamentals. According to historical data, we're only about 3 years into this cycle, and the average bull market lasts 7 to 8 years.
I think that there are maybe 3 things happening in the market right now. There's a lot of people yelling bubble. You know how I know there's not a bubble? Because so many people are yelling bubble. You can't have a bubble if everyone's yelling bubble, right? That's not how it works. The whole point of a bubble is that it basically becomes so frothy that people expect it to continue to go up. You know when it's going to be a bubble? When all the people yelling bubble capitulate, say, fine, it's not a bubble. That's when the bubble is, right? So same thing with market corrections. How many people are running around being like, market correction, it's coming, the big crash, it's overvalued, blah, blah, whatever. Howard Marks, everyone really respects him, right? Oak Tree guy writes all the memos, value investors, called multiple market corrections, etc. He was on CNBC yesterday. Guess what he said? He said, I don't think this is a bubble. I don't think that we're overvalued. I don't think the market crash is coming. I think that, it's a little expensive, but I'm not worried. Wait a minute. Hold on. The guy who's supposed to be pessimist all the time, he's actually bullish. Well, what data is he looking at? He tends to be right a lot, right? If you go and you take a look at Jamie Dimon, we're in a bull market, right? You go and you listen to all these people. They're all saying the same thing. We're in a bull market. We're in a bull market. We're in a bull market. And so there's some research recently that came out, Opening Bell Daily, Phil Rosen, shout out to him. If you look at, I think he got some of the data from Ryan Dietrich, so it's a dual shout out. The bull market right now, we're 3 years in. The average bull market, if my understanding is correct, is something like 7 or 8 years, if I remember correctly. So we got a ways to go. Everyone calm down. I think that what people are not understanding, the companies are more valuable today than they used to be. What company in history was $1 trillion growing 30% year over year? That never happened. It wasn't possible before. So what you're seeing is, of course, the valuation multiples are higher because the company's more valuable. They're getting more of their future profit faster than they used to do. So of course they're going to get a better multiple. So I think that it just comes down to, I would be very worried if stocks were being valued on promise and not results. But that's not what I see. I see actually very impressive results from a lot of these companies. And then the guidance. The guidance is really important. What I hear, Palantir is a great example. Palantir says we're going to continue growing at this rate or faster, and we're going to do it with less employees. When in history have you ever heard a CEO talk about, oh, by the way, we're growing at this really impressive rate. Our stock's up like 900% in like 2 years or 3 years. And oh, by the way, we're going to keep this rate or grow faster, and we're going to do it with less employees. Never. Usually they're like, we plan to hire 4,000 more employees. It was like a badge of honor. Like, we're going to grow to 47,000 employees. That's not what they're saying now. The competition now is how much revenue can you drive per employee? That's kind of interesting. Efficiency, more productivity out of your employees. Like, that is the world that we're headed towards. That means the companies are becoming more valuable. That means they deserve a higher valuation multiple. Now, I know people will be like, oh yeah, there's going to be a market crash, blah, blah, whatever. My bet to people out there, we have outlawed 18 months or longer bear markets. You think right now, let's just say that all the optimists are wrong. A market crash starts tomorrow, and we go down for, let's say, 20% in the stock market, what do you think the Fed's going to do?
Cut rates.
The Fed is going to go into their closet, into their shed in the backyard. They're going to get out a monetary bazooka that they're going to put on their shoulder, and they're going to fire a stimulus bill into the economy, and they are going to blow a hole into the recessionary conditions, and they are going to send us flying back in the other direction. Why? Because that's their playbook now. That is what they have learned. They are not going to allow us to be in an 18-month plus bear market. Oh, 2022. Remember 2022? How long was that? That was like 9 months, 10 months. We didn't get to 18 months, right? We hit the bottom. I think it was like November, December of 22. Oh, wait, what is that? 3-year bull market kicked off then. Remember, in November of 21, that was the top of the market. They said, we're going to start raising rates. It was a self-induced market correction. That wasn't condition-wise. The Fed induced the market to crash by raising rates at the fastest rate in history. Great. Even if the Fed did something they had never done before in history, they could not push us into an asset bear market for more than 12 months. But we never actually got the official recession.
Pompliano's bullishness isn't based on blind optimism. He points to real productivity gains. Modern companies, think Palantir, Apple, Nvidia, are delivering record growth with fewer employees. Efficiency is now the new metric of success. This is why valuations are higher. Not because of hype, but because businesses are generating more value per worker faster than ever before. And if markets do stumble, Pomp reminds us that the Federal Reserve will not allow a prolonged downturn. We've effectively outlawed 18-month bear markets. If stocks crash 20%, the Fed will do what it always does: cut rates, inject liquidity, and stimulate demand.